welcome to modern-day finance. Okay, so imagine this, right? A world where the bedrock of global finance, the U.S. dollar, it faces this unprecedented challenge. What if its reign as king were to, truly end? It sounds dramatic, I know. Maybe a bit like sci-fi. But the shifts we're seeing, these subtle yet powerful changes in global finance, they are genuinely consequential. And they could impact your wallet, your savings, your whole financial future in ways you might not even expect.
That's a crucial point. And it's exactly what we're diving into today. We're really embarking on a deep dive into these complex, sometimes dramatic shifts happening right now, from the rise of new economic powers to the very real, tangible impact these changes could have on your everyday life. We're going to try and untangle some pretty intricate topics using real-world examples, like what if hyperinflation hit your grocery bill? Or how would you personally experience a dollar crash?
Just bring us down to earth.
Exactly. Our goal is to connect those dots, give you the essential nuggets of knowledge, so you can be truly well-informed.
And we've pulled together a stack of fascinating sources for this. We're talking everything from sharp economic analysis, geopolitical deep dives, even a stark look back at historical financial collapses. Our mission today is pretty clear. Unpack all this buzz around de-dollarization. Look at why it's happening, what the potential fallout could be if the dollar, really falls, and most importantly, what it all means for you navigating modern-day finance. So let's peel back the layers. All right, let's get into it. Before we even talk about cracks, we need to really understand, what made the U.S. dollar the undisputed heavyweight champ for so long? What's the real story behind its dominance?
Well, a huge part of it is its status as the global reserve currency. I mean, for decades, the dollar has been seen as the world's financial safe haven, right? Central banks everywhere hold vast amounts of dollars. Even today, it makes up, 58–60% of global foreign exchange reserves, and that's down from over 70% at one point. But still, it's seen as the safeguard against instability, like the ultimate financial bunker for nations.
The bunker, yeah. And it's not just sitting in vaults, is it? Its dominance in trade and finance is just staggering. Our sources point out in 2023, a massive 54% of global exports were priced in dollars, even though the U.S. only accounts for a quarter of global GDP. That's a huge mismatch. Shows how deep it runs in trade.
Absolutely. And beyond trade, its financial reach, even wider. You're looking at about 60% of all bank deposits worldwide, nearly 70% of international bonds, all quoted in U.S. dollars. If you're doing big international business, chances are you're doing it in dollars. It's basically the default language of money.
So what about the petrodollar system? We hear that term a lot.
All right, that's been a key historical driver. This arrangement, it really solidified after 1971. And essentially it means oil, the world's most critical commodity, is mostly priced and traded in U.S. dollars. This forced oil exporting countries to pile up huge amounts of dollars. And what do they do with them? Often they invested them right back into the U.S. financial system, buying U.S. Treasury bonds, things like that.
Creating a loop, basically.
Exactly. A powerful self-reinforcing loop, always boosting demand for the dollar. Now, you see a lot online about this 50-year-old petrodollar agreement with Saudi Arabia expiring in 2024, our sources. They clarify that, yes, there was a U.S.-Saudi commission formed in 1974, but that specific agreement ended decades ago. The petrodollar system isn't some single contract that just expired. It's more like a long-standing market practice, a deep habit built over decades.
Okay, that clears up some of the noise. It's less about a secret deal, more about just market gravity. And beyond these mechanisms, the sheer U.S. strengths themselves play a massive role.
Oh, absolutely. You've got a huge diversified economy, incredible innovation, resilience, plus, historically at least, stable political institutions. That's a big draw when other places look wobbly.
And stability matters.
And the U.S. financial markets, they're incredibly deep and liquid. Biggest stock and bond markets globally. Easy to buy, easy to sell. Unmatched, really. Add leadership in tech, finance. It's a powerhouse. And, let's not forget the role of U.S. military and political influence. Over 70 military bases worldwide. That presence helps protect American economic interests, including, the dollar's position.
Right, it's all interconnected.
And all that leads to what economists call the network effect. This might be the most critical piece to understand because it explains the dollar's resilience, but maybe also its vulnerability. The dollar's value is, it's self-reinforcing. Think of it like Facebook, maybe. It wasn't necessarily the best platform, but because everyone was on it.
It became essential.
Precisely. The more countries use the dollar for trade, for finance, the more valuable, liquid, and essential it becomes, which makes it incredibly hard to just replace. It's a cycle of utility and trust.
So it's the operating system of global commerce, yeah. built on this network effect. But what's the key insight here? Is it just too big to fail quickly, or is there an Achilles heel we're missing?
That's the million-dollar question, isn't it? The insight is that while the network provides huge inertia, its Achilles heel is trust. Once that perception shifts, from essential operating system to maybe geopolitical weapon, well, even a giant platform can see people start looking for exits, slowly, then maybe all at once. Which leads us right into why we're seeing these cracks in the foundation appearing now.
Okay, that makes sense. Trust is the bedrock.
Yeah.
So if the foundation is trust and that network effect, what specifically is chipping away at that trust? What's causing these cracks?
Well, probably the single biggest catalyst recently has been what some are calling the weaponization of the dollar. After the Ukraine conflict started, the U.S. and its allies, they froze something like $600 billion in Russian central bank reserves. Just poof, frozen.
600 billion, wow.
Yeah. And for many other nations, that was a massive wake-up call. It basically signaled that holding huge dollar reserves comes with real geopolitical risks if you fall out of favor. So it prompted them to actively start looking for alternatives to reduce their dependence on the dollar system.
Because the U.S. has used its dominance before, right? To enforce policies, block transactions, even kick countries out of payment systems like SWIFT.
Exactly. It's a powerful tool. But using it so dramatically with Russia, it inadvertently pushed a lot of countries to seriously reconsider their reliance on the greenback. Planted seeds of doubt.
A chilling thought, yeah. Having your nation's savings frozen overnight. And speaking of policies creating uncertainty, what about U.S. economic policies and debt? That seems to be a big factor, too.
Undeniably. Let's talk about the money printing. During the COVID pandemic, the U.S. created, around $14 trillion and sent a lot of it directly to Americans in just 3 years.
14 trillion.
An unprecedented amount. Now, the goal was stimulus, obviously, but some sources argue that this massive injection of cash significantly fueled inflation, and that, in turn, weakened trust in the dollar's long-term stability. It's like flooding a system, each unit becomes worth a bit less.
And then there's the soaring national debt. It's hard to even wrap your head around the numbers now.
It really is. It surpassed $36 trillion. That's about 124% of U.S. GDP. And get this. The cost of just paying the interest on that debt, it's now over $1.2 trillion a year.
Just the interest.
Just the interest. That puts a massive strain on the budget, less money for everything else, and it has real consequences for perception, too. Moody's, one of the big credit rating agencies, downgraded U.S. credit. So the U.S. no longer has that perfect AAA rating from all three major agencies. That's a clear signal, an erosion of financial confidence from the experts looking at the books.
And things get even messier when you factor in unpredictable policy. The whole Trump effect, maybe. Our sources mention things like tariffs, just a generally unpredictable stance, creating a lot of economic uncertainty globally, disrupting supply chains, boosting inflation, all potentially speeding up the dollar's decline.
That unpredictability makes planning incredibly difficult for international businesses and governments. And you even hear whispers, maybe more speculative, about things like a Mar-a-Lago Accord. This humored idea of intentionally devaluing the dollar by, say, 20%.
Which sounds kind of wild, but the fact it's even discussed, reminiscent of the Rio Plaza Accord back in '85, it just speaks volumes about the uncertainty, doesn't it?
Yeah, it absolutely does. Perception is reality in currency markets. Any hint of instability, real or rumored, can have a huge impact. And all this feeds into a broader shifting global confidence. We're starting to see it in the numbers. The U.S. dollar index, the one measuring its strength against other major currencies, it dipped below 98 recently, lowest since the 2020 pandemic hit. And some analysts are predicting it could fall further, maybe towards 91 by next year.
And what's really striking is, in past crises, everyone usually rushed into the dollar, right? The ultimate safe haven.
Okay.
But not this time.
That's the key deviation. This time feels different. Which leads to that fascinating gold versus dollar decoupling you mentioned. Gold has surged, past $3,550 an ounce in April 2025, apparently, up over 20% this year alone. Historically, gold and the dollar often move together in crises both seen as safe. But now, gold's up, dollar's down. It feels like a clear vote of no confidence in the dollar's traditional role, like the market is saying something fundamental has changed.
And this lack of confidence, it's showing up in investment flows, too. Foreign investment retreat.
Starkly evident, yeah. Foreign demand for U.S. treasuries plunged by 30%. Central banks have offloaded around $48 billion in U.S. treasuries. Japan, China, historically the biggest buyers, they're quietly pulling back. And institutional investors, hedge funds, the Swiss National Bank, Saudi Arabia's sovereign wealth fund, They are actively moving money away from dollar assets.
Where are they putting it?
Well, a JP Morgan report showed hedge funds have their lowest share of dollar assets in 15 years. They're moving into places once seen as riskier local bonds in Argentina, Brazil, Indonesia. Even the euro is making a comeback as a perceived safe haven. That's a significant inverted reaction compared to how things usually work.
A real tectonic shift. And it's not just giant funds, right? You mentioned exporters refusing dollars.
Yeah, we're seeing real-world examples. An exporter overseas saying, no thanks on the dollars, pay me in euros or yuan or even pesos. Imagine an American company trying to buy parts, and their supplier just won't take dollars anymore. It's actually happening. Even some American companies are switching currencies for deals just to keep business flowing because their foreign partners don't trust the dollar's stability. It's hitting the ground level.
Wow. And this concern isn't just external, is it? There's domestic concern, too.
Right. That Deloitte survey, over 63% of CFOs at top U.S. companies see the U.S. as financially unstable. Why? Too much debt, political infighting. These are the people managing billions. If they lack confidence, why would global markets feel secure? Even Goldman Sachs sent out a warning, saying the dollar's fall is due to bad sentiment and deeper structural problems, basically saying, don't expect an easy bounce back. The shift feels psychological, driven by fear and cracking trust.
Okay, so if confidence in the dollar is cracking, who's actually positioned to challenge its long reign? That brings us squarely to the BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding alliance. They seem to be emerging as a major force.
Yeah, BRICS started, early 2000s? Initially, it was more of a loose economic grouping, developing nations focused on, trade, investment cooperation. But it's clearly evolved. It's become a real geopolitical force now. And they have a very clear objective: break free from what they see as the shackles of Western financial dominance. They're not just talking about reducing dollar reliance anymore. They're actively putting strategies in place.
And it feels like they're picking up speed with this momentum and expansion.
Definitely accelerating. The core group expanded. It's 10 nations now, and reports say over 30 other countries are applying to join. And what's really key about this expansion is who they've brought in. Major oil producers like the UAE and Iran are now part of this BRICS Plus group.
So that directly connects back to the petrodollar system we talked about. How does bringing in oil producers challenge that?
It's a critical strategic move. By including major oil exporters, BRICS gains significant leverage against the dollar. If these countries agree to trade oil in, say, yuan or other local currencies, that directly hits the core mechanism that's propped up dollar demand for decades. It adds serious weight to their de-dollarization plans, makes it less theoretical, more of a tangible shift in global energy markets. It's like a quiet rebellion suddenly getting serious muscle. #tag 2.2 strategies to weaken dollar's grip.
Right. So it sounds like a multi-pronged attack, almost.
Right.
What are some of the specific de-dollarization initiatives they're actually using?
They've got a few key tactics working together. One big one is pushing for local currency trade. They're setting up these bilateral agreements, trading directly with each other using their own currencies, cutting out the dollar middleman.
Like who, for example?
Well, Russia trading oil with China using yuan. India offering rupee trade options to countries struggling with dollar shortages. Brazil and China trading directly in their local currencies. Each deal chips away a little bit at the dollar's role as the go-to global currency, reduces its perceived necessity.
And to make that easier, they're building their own infrastructure, these alternative payment systems.
Exactly. The BRICS Bank, its official name is the New Development Bank, was set up as an alternative to the World Bank and IMF, which are often seen as Western-dominated. And this BRICS Bank, it's funding major infrastructure projects in developing nations. And critically, it's doing more and more of that without requiring dollars.
And China's system, CIPS, you mentioned it saw a huge jump in use after Russia invaded Ukraine. How is CIPS different from SWIFT, and why is that strategically important?
Great question. It highlights the strategy. SWIFT basically is a messaging system. It helps banks send payment instructions, often for dollar transactions. CITS, though, is designed specifically for clearing and settling renminbi yuan transactions directly, globally. So when Russia got cut off from SWIFT, CIPS became a vital alternative for conducting trade outside the dollar sphere. Its growth, that 50% jump after Ukraine, another 25% in the first 3 quarters of 2023, shows it's gaining real traction as a competitor. It's like building parallel financial plumbing, bypassing the dollar's choke points. More autonomy for nations.
Parallel plumbing. That's a good way to put it. And then there's the tech angle. Central bank digital currencies, CBDCs, you call them revolutionary. How do they change the game for cross-border payments, and why is that a threat to the dollar?
Okay, think of it like this. Right now, if, say, Brazil wants to pay China for something, that transaction often has to route through a dollar banker system, like a mandatory middleman relying on dollar plumbing. With CBDCs, countries could potentially use their own digital cash directly, peer-to-peer. Sovereign digital currency transfer. It could completely bypass all those dollar intermediaries. No need for a global reserve currency as the common denominator for settlement. That fundamentally changes the existing financial architecture, makes a single settlement currency way less necessary.
Okay, this is where it gets really ambitious. They're not just trying to work around the dollar. Our sources say BRICS is actively planning its own reserve currency,
Where
possibly backed by gold, oil, commodities. That's a direct challenge.
it is a frontal assault on the dollar's reserve status. And part of that strategy seems to be stockpiling gold reserves. Central banks globally, including BRICS members, have been buying record amounts of gold, diversifying away from the dollar. It's a tangible step. Protect themselves from potential dollar fallout, maybe lay the groundwork for a new system, almost like they're trying to rebuild global finance with gold as a foundation again.
And why are so many developing nations jumping on this bandwagon? You mentioned addressing dollar shortages.
Right. Many emerging markets, think Argentina, Egypt, Ethiopia, they're facing severe shortages of US dollars right now. This lack of dollars can cripple their economies, makes imports expensive, fuels inflation, makes it hard to function. So these shortages are directly pushing them towards non-dollar options like the renminbi. They're desperate for stability and autonomy away from what some, like certain Chinese journals, call the dollar's hegemony that seizes the wealth of other countries. They want out from under the dollar's thumb. Hashtag 2.3, the renminbi's role and challenges.
Okay, within BRICS, China's currency, the renminbi's role, seems central. It's the most used BRICS currency globally, right? Helped by things like offshore clearing banks and swap lines.
No doubt the renminbi, or yuan, is leading the charge among BRICS currencies. Mechanisms like offshore clearing banks let foreign entities hold and use yuan more easily. And these bilateral swap lines from the People's Bank of China, they give other central banks access to yuan, especially during liquidity crunches. It greases the wheels for its international use.
But it's not all smooth sailing for the renminbi, is it? There are still lingering dollar ties and big challenges.
Definitely. Despite the push, the dollar's roots are deep. Our sources showed that as recently as 2022, nearly half of China's own external debt was still in dollars, over half of India's too. And Brazil's foreign reserves, reportedly still over 80% in dollar assets back then. It just shows how ingrained the dollar system is, even for those trying to move away.
So what are the main hurdles for the renminbi becoming truly global?
Well, a couple of big ones. First, it's still not as freely available outside China compared to the dollar or euro, and Chinese government policies still place restrictions on its convertibility, how easily you can swap it for other currencies. For the renminbi to really challenge the dollar as a reserve currency, it would likely need to be more freely convertible, or China would need massive dollar reserves itself to manage the exchange. So, yeah. BRICS is making moves, but dislodging the dollar, that's a monumental long-haul project.
Okay, this is where it gets pretty sobering. We've talked about the dollar's history, the challenges. But what does it mean for you listening? What actually happens if the dollar, this financial bedrock, really takes a nosedive? Our sources paint a stark picture. They call it a potential currency war with devastating consequences.
Yeah.
Tax 3.1, a currency war with devastating consequences.
Let's try to make it concrete, even if it's unsettling. Imagine Jeff, right? Just an average American. Wakes up one morning, headline screams, US dollar crashes overnight. He checks his bank account, the numbers look the same, but suddenly, they're almost worthless. That's personal financial ruin on a massive scale. The value of his savings, his 401k, even his next paycheck could be slashed. Maybe in half, maybe more. Almost overnight. It hits everyone, not just Wall Street.
And that leads directly to hyperinflation, right?
Yeah.
Where prices just spiral completely out of control.
Exactly. Gas, groceries, rent, everything becomes incredibly expensive, incredibly fast. Your purchasing power just evaporates. And all those imported goods we rely on, forget about it, sky-high prices. The Federal Reserve, our central bank, they'd have very little power to stop it at that point because the trust that held the dollar up would just be gone, irrevocably broken.
Then there's the national debt crisis. If nobody wants dollars or U.S. debt anymore.
Demand for treasury bonds plummets, which forces interest rates to spike dramatically. Think about borrowing money, mortgages, car loans, student loans suddenly becoming much, much more expensive for everybody. And for a country already sitting on, what, $36 trillion in debt, it could be the tipping point. The whole economy goes into a tailspin.
because the government can't easily finance its debt anymore.
Right. Without that safety net of being the world's reserve currency issuer, the U.S. government would struggle massively. And that inevitably means deep cuts. Public services, social programs, infrastructure, things millions rely on every single day would face huge reductions.
It paints a really grim picture of economic devastation and social unrest, but beyond just numbers.
It does. We're talking businesses failing left and right, mass unemployment, widespread protests, potentially even civil unrest. Some sources describe scenarios. Stores looted, gas stations refusing dollars, demanding, something tangible in return. Society struggling to function. You might even see things like martial law, curfews, just to maintain basic order, prevent society from tearing itself apart. It's terrifying to really think about that breakdown.
And this wouldn't just be a U.S. problem, would it? The global contagion.
Oh, absolutely not. The dollar's collapse would send shockwaves everywhere. Every aspect of global life, currencies that are pegged to the dollar, they'd go into freefall, creating chaos across the global economy. Countries might retreat into isolation, pull back on trade, leading to a really fragmented, fractured global economy. The ripple effect would be immense, a domino effect of economic turmoil. Hashtag 3.2, historical precedents of hyperinflation.
Now, some listeners might be thinking, okay, this sounds extreme. Has anything like this actually happened before? Unfortunately, history gives us some pretty stark historical precedents of hyperinflation. Chilling warnings, really. It's hard to even imagine, isn't it? Your money just evaporating hour by hour.
Yeah, the most famous example is probably Weimar Germany in the 1920s. After World War I, the government just printed massive amounts of money to pay war reparations, and the economy completely collapsed. Our sources talk about people literally burning stacks of cash for warmth because it was cheaper than firewood.
Cheaper than firewood. Wow.
At its peak, inflation was over 30,000% per month. Prices doubling every few days. It's a potent example of a currency just losing all meaning and the central bank becoming totally irrelevant.
And more recently, Zimbabwe, 2007 to 2009.
Equally shocking, inflation hit. Well, the number is almost meaningless. 89 sextillion%. The government printed trillion-dollar bills. Literally. And those bills couldn't even buy a loaf of bread.
$1 trillion for less than a loaf of bread.
Imagine that. Money becomes utterly useless. Society's basic functions break down. It shows what happens when faith in currency disappears completely.
And the worst ever recorded. Hungary in 1946.
Right after World War II, prices there doubled every 15 hours. Inflation hit 41.9 quadrillion% per month. These aren't just abstract numbers. They represent total economic chaos, lives turned upside down, bartering replaces buying. So while a complete dollar collapse today is maybe low probability, these historical events show the devastating reality of what can happen with uncontrolled money printing and a total loss of confidence.
Right. So it's clear the fallout would spread far beyond the U.S. borders. The whole world economy would be shaken. Currencies tied to the dollar would just tank.
Precisely. An interconnected global crisis. No nation would be completely untouched. You might see countries react by choosing isolation over cooperation, pulling back on trade, even with each other, leading to that fractured global economy we mentioned. Now, maybe, just maybe, long-term developing countries could gain more monetary autonomy out of this. But that transition, it would be incredibly risky, full of uncertainty, currency volatility, issues accessing capital. It's a turbulent, dangerous path toward any potential new global order.
Okay, so let's flip the coin. If the dollar were truly seriously threatened, what would the U.S. do? Because let's face it, empires don't just sit back and watch their power crumble, right? The U.S. surely has ways to try and maintain its financial supremacy. Beyond the obvious, what are some strategic plays? Hashtag 4.1 strategies to protect the dollar status.
Well, one theoretical path, though may be tough given current trends, is shoring up fiscal strength and policy. If the U.S. could somehow drastically cut its debt, control spending, and really strengthen its financial position, that might reassure investors and help withstand pressure. But as we've discussed, that soaring national debt, the huge interest payments, they make this incredibly difficult right now. It's like trying to turn a battleship on a dime.
Right. A huge challenge. But then there's the harder power, military and geopolitical influence.
Can't ignore that. The U.S. has the world's most powerful military, and history shows it's willing to use it to protect its interests. Some provocative voices even float the idea, when all else fails, they take you to war. It sounds extreme, but it's part of the power calculus. And remember those 70-plus military bases globally? That presence helps protect American interests, including dollar supremacy.
So you mean like pressuring countries or protecting trade routes?
Potentially. If rivals gain too much influence, the U.S. could leverage military power. protect shipping lanes critical for dollar-based trade, maybe pressure key countries to stick with the dollar system. It's a stark reminder that economic power and military power are often intertwined.
And in the modern era, there's technological and financial warfare too, right? Cyber attack.
Absolutely. This is a huge, often unseen battlefield. Our sources suggest the U.S. could potentially use cyber attacks. Imagine disrupting BRICS financial systems just as they're trying to launch alternatives, undermining their currencies, maybe even crippling critical infrastructure. Think of the chaos if BRICS payment systems suddenly went offline, or their banks were in turmoil. The U.S. has significant capabilities here. If the dollar felt truly cornered, it's a weapon they might well consider using.
A powerful hidden weapon. And finally, the perhaps more familiar tactic, printing more money.
Yeah, the Federal Reserve could try to flood the system, inject massive amounts of dollar liquidity into global markets, make it harder for other currencies to gain traction. But, as our sources warn, this is a dangerous gamble. It might buy some time, sure, but it risks stoking massive inflation back home, and it would almost certainly further erode global trust in the dollar. It could easily backfire, actually accelerating the decline instead of stopping it. A real double-edged sword. Hashtag 4.2, the nuance of decline versus collapse. Now, it's really important here to grasp the nuance of decline versus collapse. These are not the same thing. A weaker dollar, that doesn't automatically mean it's collapsing or losing its reserve status. History shows the dollar's value fluctuates. It's been weaker before without the sky falling. That's a crucial distinction.
And that brings us back to that inherent resilience, the network effect resilience.
Exactly. Remember, the dollar isn't just valuable because the U.S. is strong. It's valuable because everybody uses it. That creates this massive inertia, this self-reinforcing cycle of liquidity and utility. It's incredibly difficult to just unwind that quickly. Even if some countries want to move away, the sheer weight of this global network acts as a powerful stabilizing force. You can't just flip a switch and have everyone stop using it overnight.
So maybe not a sudden collapse, but more of a gradual shift towards a multipolar currency system. Is that a more likely future?
Many analysts think so. Instead of one dominant currency, the future of global trade might involve multiple settlement currencies, countries using various currencies depending on the trade partners, the specific deal. This could lead to a more diversified global financial system, maybe even more stable in the long run, without one currency holding all the cards. The world's probably too interconnected now for just one currency to rule everything forever.
And Ray Dalio's Empire Cycles perspective fits with this idea of a slower shift, right?
It does. Dalio observes that an empire's reserve currency status is often the last thing to go, typically like 20 years after other things like economic output or military strength have already peaked. He suggests that while the U.S. might have peaked in some ways, it's likely only midway through its overall cycle as a leading power. Maybe 80 years in, give or take. So yes, competition is rising, challenges are real, but it might be more of a slow generational tide going out rather than an immediate tsunami.
And finally, that U.S.-China interdependence. That must play a role in preventing catastrophe.
A huge role. The U.S. is China's biggest customer. China is America's biggest supplier. Their economies are deeply intertwined. A devastating, all-out conflict, economic or otherwise, would be mutually destructive, just catastrophic for both. So instead of one completely replacing the other, some sources suggest a scenario where the U.S. and China might just run in parallel for a long time. Dual world powers, coexisting, competing, but too interconnected to fully decouple. It's a complex dance.
Okay, so bringing it back home. Given all these shifts, all this uncertainty about the dollar's future, what does this mean for your personal finances? How can you actually protect your wealth, no matter how things play out? It can feel overwhelming, I know, but history actually offers some valuable clues. Hashtag 5.1, understanding financial crises and bubbles.
Yeah, the first step is really understanding financial crises and bubbles, recognizing the historical warning signs. Because history might not repeat exactly, but it sure does rhyme, as they say. We see these patterns pop up again and again before major downturns, like a financial playbook almost.
And one of the biggest culprits, time after time, seems to be speculation and debt, right?
Absolutely. Think back, the Great Depression, fueled by crazy margin trading people borrowing heavily to gamble on stocks. The 2008 housing crisis, driven by risky subprime lending giving mortgages to people who couldn't really afford them. In both cases, it was speculative behavior, buying stuff with no real underlying value, or borrowing way too much to buy assets combined with massive debt that created these unstable bubbles. When the music stopped, boom, implosion.
Yeah. Mm-hmm. And another sign you often see is the wealth gap widening.
Historically, yes. When you see extreme economic inequality, the rich getting much richer, While the middle class stagnates or falls behind, that often precedes major collapses, it creates social and economic fragility, makes the system less stable, so when a crisis does hit, the fallout is often much worse. Deeper divisions.
And then there's the human psychology part. FOMO and herd mentality. Fear of missing out.
Oh, yeah. Bubbles are often pumped up by FOMO. Everyone rushes into an investment just because everyone else is doing it. Prices get totally detached from any underlying reality or value. Remember Dogecoin? Worth more than some Fortune 500 companies at one point. Pure hype, not fundamentals. And the real danger sign is often when the smart money starts quietly heading for the exits.
The smart money exiting. Explain that.
Well, while everyday investors are caught up in the frenzy, piling in, the savvy, experienced investors often start strategically, quietly selling off their holdings as things peak. They take their profits. They don't necessarily try to time the absolute top, but they recognize when things are overheated and it's time to reduce risk. Then, when the bubble eventually bursts, it's the herd, the ones who held on too long, who are left holding the bag with huge losses. Hashtag 5.2 personal strategies for resilience.
Okay, so if the smart money might be hedging,
Mm-hmm.
what can you do personally? It really comes down to proactive personal strategies for resilience. And rule number one seems to be diversify investments.
Absolutely critical, and that means diversifying across asset classes and internationally. Don't keep all your eggs in one basket, and definitely don't keep them all just in US dollar assets if you're worried about its future. Spread your money across different things, stocks, bonds, maybe some alternatives, and look beyond just the US market. Explore international investments to reduce that single country risk.
And in shaky times, thinking about real assets versus paper wealth becomes important too.
Very important. Real assets. Things like actual physical real estate or businesses that generate cash flow. They tend to hold their value much better during downturns than paper wealth, like cash or maybe even stocks. Why? Because they have intrinsic utility. They produce something or provide shelter. They can generate income, which helps offset inflation or currency devaluation. It's about owning tangible things, not just numbers on a screen.
What about other tangible assets like gold and silver?
They can play a role. Historically, they've been hedges against inflation and currency wobbles, a store of value when trust in paper money fades. But our sources stress caution. Don't go all in. Maybe 5–7% of your net worth, tops. Because gold and silver, they're not immune to bubbles or price drops themselves. Gold can get caught in a frenzy too. So view it as a hedge, a piece of the puzzle, not the whole solution.
Okay. What about things designed specifically to fight inflation, inflation-protected securities?
Yeah, things like TPS, Treasury, inflation-protected securities, or Series I savings bonds. These are useful tools. They're indexed directly to inflation. So their value, or the interest they pay, actually adjusts upwards as inflation rises. It's a direct way to help protect your purchasing power if the dollar weakens and prices go up, a specific defense against that value erosion.
And for a broader strategy, you mentioned Ray Dalio's all-weather portfolio earlier.
Right. It's a portfolio construction strategy. The goal is to build a mix of assets that's designed to perform reasonably well no matter what the economy is doing, growing, shrinking, high inflation, low inflation. It's about being prepared for any environment rather than trying to guess what's coming next. The focus is really on preserving capital through different economic seasons.
Okay, shifting from investing, maybe the most crucial step is to eliminate risky debt.
Hugely important. Maybe the most important for personal resilience. Before a crisis hits, getting debt-free, especially high-interest debt like credit cards, that's paramount. Debt turns a regular recession into a personal catastrophe. If your income drops or interest rates spike, those payments can become crushing. Cleaning up your personal balance sheet now, while things are relatively stable, that's one of the best defenses you can possibly build.
And to build more resilience on the income side, build multiple streams of income.
Yes. Don't rely 100% on just one job if you can help it. Diversify where your money comes from. Maybe a side business, some rental income, dividend-paying investments. Anything that provides another income stream. This gives you crucial stability if one source gets disrupted by an economic downturn. It's like creating your own personal economic safety net.
And for the actual process of investing, dollar cost averaging seems like a solid approach.
It's a fantastic strategy, especially in volatile times. It just means investing a fixed amount of money at regular intervals, say, every month, regardless of what the market is doing. By doing this consistently, you end up buying more shares when prices are low and fewer when they're high. It averages out your purchase price over time. It takes the emotion out of it, reduces risk, and stops you from trying to make impossible time the market guesses. It's discipline, systematic wealth building.
And finally, underpinning all of this, Educate yourself continuously.
Absolutely essential. Pay attention to what's happening globally. Try to understand the financial system beyond just the headlines you see every day. Be proactive. Seek out different sources of information. The world is changing fast, and those who stay informed are simply better positioned to protect themselves, adapt, and maybe even spot opportunities. Hashtag 5.3, the hidden opportunity.
Which brings us to that final point, maybe a slightly brighter note, the hidden opportunity. Because while downturns and crises are scary, our sources do say they create these massive wealth transfer opportunities. Sounds weird, but true.
It is true. For people who are prepared, they've diversified, they've cut debt, they've built resilience, these periods of panic can actually be times to acquire valuable assets at bargain prices. When everyone else is panicking and selling indiscriminately, those who kept their cool and have cash available can step in. It's about being positioned to be greedy when others are fearful, as Warren Buffett famously said. It can turn potential chaos into significant long-term gain. It's really the ultimate reward for patience, discipline, and preparation in the face of uncertainty.
Hashtag tag outro.
Wow, what an incredible deep dive that was. We've really journeyed from the dollar's, seemingly unshakable dominance all the way to the efforts by countries like BRICS to forge a completely new financial order. We explored the very real, sometimes terrifying implications if the dollar were to truly collapse. But we also found some perspective in the lessons history offers about these kinds of economic cycles. And we've definitely uncovered how, even when things feel uncertain, there are concrete, tangible steps you can take to protect your own financial well-being. From diversifying investments, building multiple income streams, to just how critical it is to get rid of that risky debt. The world of finance, it is definitely not standing still.
No, it's clear the world is changing, maybe faster than a lot of people realize. And this fight for financial supremacy, it feels like it's really just beginning. The dollar faces challenges it hasn't faced before, and whether it's a slow fade or something more dramatic, the global economic landscape is definitely shifting under our feet.
Yeah, so the question really isn't if the dollar will be challenged anymore. It's whether you will be ready when it is.
So think about it. What steps will you take to prepare for this evolving world of modern-day finance? We really hope this deep dive has given you some thought-provoking insights, maybe some practical things to consider as you navigate these fascinating and definitely turbulent times.